Welcome to The Explainer. So we're going to tackle a really big question today. How exactly is climate change shaking up India's entire banking world? We're going to break down everything from the global rules to the strategies on the ground right here, giving you exactly what you need to know for your exams.
So let me ask you something. Think about this for a second. Can a crazy heat wave, one of those blistering ones in North India, actually cause problems for a bank all the way down in Bengaluru? It sounds a bit disconnected, right? Well, the answer is a huge yes. And believe me, it's changing absolutely everything.
And that's because of this one core idea you've got to get. Climate risk is now financial risk. They are one and the same. So that's what this whole explainer is about. We're going to dive deep into how banks are scrambling to prepare, and we'll be zeroing in on the key stuff you really need to know for your exams.
All right, Section 1, the Global Rule Book. So who is actually setting the standards here? To really get how banks are reacting, you've got to start with who's writing the rule book. Let's look at the big global players.
Okay, first up, you've got the NGFS. The easiest way to think about them, they're like a global club for all the big central banks. And yes, that includes our very own RBI. Their main job is to cook up these detailed climate scenarios, like what if the world gets really hot, that banks all over the world then have to use for their planning.
Then there's the ISSB. Now, these guys are all about one thing: transparency. Their whole mission is to make sure everyone is speaking the same language. They create these universal reporting rules. IFRS S2 is the big one to remember, so that a company in Mumbai has to report its climate risks in the exact same way as a company in, say, Munich. No hiding, no confusion.
And finally, you have the BCBS. This is the big one, you could say the big boss of global banking regulation. What they do is take all the scenarios from the NGFS and the reporting rules from the ISSB, and they turn them into actual hard and fast rules for banks. Their job is to make sure this whole climate thing doesn't blow up into another financial crisis.
So here's the key takeaway, how it all fits together. Think of it like a three-legged stool. The NGFS provides the what-if climate scenarios. The ISSB gives us the rules on how to talk about those scenarios. And the BCBS is the enforcer, making sure banks actually follow the rules to stay stable. You need all three for the system to work.
Okay, on to Section 2, the bank's playbook. So we've got these big global rules, right? But how does a bank on the ground actually turn all of that into a concrete strategy? Well, that's where frameworks like the one from UNEP-FI come into play. Now, this 5-step process, this is an absolutely golden framework to remember for your exams. It's the logical path every single bank is supposed to follow. First, understand the local context. Then, figure out your own risks. Set some clear goals. Make a detailed plan. And finally, the most important part, actually do it and keep track of it. And when we talk about setting targets, you've got to know the difference between these two types. It's simple, really. Practice targets are all about what's happening inside the bank, improving their own processes. But impact targets, those are about the outside world. They measure a real, tangible result, like actually helping a chunk of their customers become safer from climate change.
All right, here's one of those mnemonics you're going to want to write down because this stuff is super testable. For the NGFS building blocks of a bank's transition plan, just remember the GFEM plan. That's G for governance, F for foundations, I for implementation, E for engagement, and M for metrics and targets. GFEM. Got it?
Now for Section 3, shifting the risk. Look, a bank can't just absorb all of this risk on its own. It would collapse, so they need to offload it. Let's get into the really cool, innovative financial tools they're using to pass the hottest potatoes, the most catastrophic risks, to someone else. But first, another quick memory aid for you. When you hear physical risk, I want you to think heavy risk. Heavy, because risk is made of 3 parts. The H, hazard, which is the event itself, like a flood. The E, exposure, meaning the stuff that's in the way, like a factory. And the V, vulnerability, which is how likely that factory is to get wrecked. Hazard, exposure, vulnerability.
So one of the real game changers here is something called parametric insurance. This is so clever. Instead of waiting months for some claims adjuster to show up, this insurance pays out automatically the second a predefined trigger is hit. For instance, if rainfall goes over 200 millimeters, bam, the money is in your account. That speed is absolutely critical for recovery.
And then you have these things called catastrophe bonds, or CAT bonds for short. This is where it gets really interesting. An issuer basically sells the risk of a disaster, like a major hurricane, to investors. The investors get a really nice return unless the disaster happens. If it does,
Poof, their investment money is used to pay for the damages. It's basically a way to let the entire global financial market act as an insurance company.
And don't think for a second this is some tiny niche market. As of 2024, the total amount of money in these cat bonds was about $49.5 billion. That's a staggering number. But what does a number that big even mean in real terms?
Well, let's put it in a context we can all understand. That's nearly 4 lakh crore rupees. To give you some perspective, that is more than India's entire annual budget for education. Just let that sink in. We're talking about a massive, massive amount of capital being deployed just to manage these risks.
All right, Section 4, Banks Learning from Insurers. So how exactly are banks starting to think like insurance companies? Let's look at some real-world examples of how this is happening, including a really important one from right here in India.
And yep, you guessed it, here comes another mnemonic. The strategy banks are borrowing from the insurance world is called the AAT attack on risk. AAT. It's a 3-pronged attack. You can accept the small stuff. You can help your clients adapt to make their assets stronger, or you transfer the really scary risks to someone else.
Okay, let's get concrete. Here's a fantastic case study from India that you can totally use in your exam answers. Let's break down what Yes Bank is doing.
So what's so smart about what Yes Bank is doing? The key is that it's not just about throwing money at the problem. Yeah, they offer cheaper loans for things like solar irrigation in disaster-prone areas, but, and this is the crucial part, they combine the loan with financial literacy and actual training. They're not just financing a project, they're building resilience from the community level, from the ground up.
Okay, last section, let's do a super quick rapid-fire revision to make sure all these key concepts are locked in your brain. Think of this as your final exam cheat sheet.
First question, a real foundational one. What are the 2 main types of physical climate risk? That's right, it's acute and chronic. Acute risks are the sudden shocks, like a massive storm or a flood. Chronic risks are the slow, creeping problems, like sea levels rising year after year.
Okay, next up, give me the 2 big financial tools we talked about for transferring or shifting that risk.
You got it. Parametric insurance for those super fast automatic payouts, and catastrophe bonds or cat bonds, which use the power of the global market to cover massive disasters. All right, last one. Let's circle all the way back to the rule makers. What is the main point, the primary goal of that ISSB standard we mentioned, IFRS S2?
It's all about creating one single global standard for talking about climate risk. The goal is simple: transparency and consistency, so that an investor can look at 2 companies from anywhere in the world and actually compare them, apples to apples. And that, right there, is how the entire world of finance is being fundamentally rewired for our new climate reality.